All right. Hello, everyone. This is my video explanation of I call it my SMA table, but basically it's a stock screener supported by the Google Finance Excel sheets that you can use for free on Google Drive. So without any further ado, let's get into it. I know that there are a lot of people out there who do not understand investing, don't understand the markets. Um, you can tend to think that it's either a scam, and in some regard, you may be right, depending on certain factors playing in the market, institutional investors moving millions, if not billions of dollars. So, as the little guy, we can all find things that we can learn that are new and improve our own investing techniques over time. So what I have here is a comprehensive spreadsheet. I've got 3 tabs, as you can see at the bottom. I've got stocks listed over here on the left, and I've got all these data points. I've put about 6 months worth of revising and editing and research into how to do these algorithms, the equations for some of these numbers, such as moving averages, growth rates, earnings yields, and things like that, to help give me an idea of what stocks I would like to invest in, and also to tell me what the market is doing. So, for example, we'll just start off with Apple. It's a good classic stock everyone knows. People have made a lot of money off of it. As you can see right now, the price is $310.13. The 200-day moving average is 265. The 50-day moving average is 276. So right now, the stock is high. It is above those two metrics. If it was below, you would say that it is cheap, or cheaper, basically. And these moving averages can tell you a lot about a stock. 200-day moving average is regarded as a long-term trend that's a little over 6 months. The 50-day moving average is regarded as a short-term trend that's a little under 2 months. These are just numbers that are typically used in the investing world, if you will. And then here I have 2 columns that are conditional. They tell me if the price is above or below 50-day or 200-day SMA. Again, you can see down here AT&T is currently below those, and it shows up green. My intrinsic value calculation is based on whether or not it's more than 5% undervalued from the intrinsic value, which is just the market cap divided by the number of shares vice the actual share price. It's a comparative between those two to let you know if there's something wrong with the valuation. That doesn't always work here with Google. Google had a stock split. This doesn't reflect that, so your intrinsic value is way off. 2,800 vice a stock price of 1,388. So that's just one issue you can have with those, but that requires you to have some contextual knowledge of stocks like Google and Alibaba that have had stock splits. So we've got our number of shares, number of outstanding shares for the company. We got the market capitalization, which is what the company is evaluated to have access to as far as market share. Again, the intrinsic value. We have earnings per share. That's a good metric for calculating your price to earnings ratio, but Google Finance also provides the PE ratio just by the function PE. And then your beta score is a measure of volatility. So if it's above 1, the stock is calculated to be more volatile than the market. And if it is under 1, then it is calculated to be less volatile than the market. And that's just another metric. Some of these are green. I think I set it to be that they'll highlight green if it is below 1. And that is to show me what stocks are less volatile in the current market conditions. And then we have the 1-year growth, the 5-year growth, price to earnings over the growth ratio. If you've read the book One Up on Wall Street by Peter Lynch, that's a ratio that he is big on. I don't know that it is easily calculated with this type of chart, so I don't really use that metric as much, but it is another good number to try to evaluate a company. And then I have a column that if this column turns green, it means about 5 or 6 metrics have been met, which is very rare. And both times that I've bought stocks based on this column highlighting, it was Qualcomm and Disney. And when I bought and then sold a little while later on those, I made money. So that was just it was a test to see, well, if I have this column light up and just tell me when I should buy a stock, then what would it do? So I experimented with that and it did work twice. It worked a third time with Snapchat. But what you have to know about this column is that it lights up very briefly, maybe once in a long time, very, very infrequently, because this requires the stock to be under the 50-day moving average, under the 200-day moving average. It has to have a 1 year and 5 year growth, as well as a price to earnings to growth ratio. Price earnings to growth ratio that is also highlighted green by my table. So for all those 5 things to align is very rare, and if it does happen, it will not happen for long, because I assure you, other people on Wall Street are paying attention to companies that have high growth rates but are undervalued. So that's basically what that will tell you. High growth rate, undervalued, and it does not, you are not in that window for very long. Over here we have the earnings yield. So that's like, what is the stock's return based on the company's earnings? So this is a good ratio, again, for something called the Magic Formula by Joel Greenblatt. You can Google that. There's a couple websites that do Magic Formula stock screeners. It sounds really corny, saying Magic Formula, but basically it evaluates the earnings yield and the return on invested capital of a company. And using that formula and ranking stocks accordingly, you take the top stocks that meet those criteria, and are doing better than other companies in both of those criteria, and then you can kind of start to find undervalued companies that are putting their capital to work. They have cash on hand, and they are basically getting a good return on their investments, which tells you that they're moving in the right direction. And then my last column over here, it automatically tells me if I'm outperforming the S&P 500, and it is correlated to SPY, which is an ETF covering the S&P 500. And it's outperformed relative to the 5-year growth rate, which down here right now, today on May 11th, is about 39.24%. Like how much it's grown in the last 5 years. So, the market's a little low right now. Pandemic status going on. We might see another dip here soon. So that gives you about 8% a year. And then so what you have is ultimately you take all of these metrics and you look across the table, right? So we've got Apple's an outperform, Google's an outperform, but they're both overpriced. But if we come